Let's bring in Michael Contopoulos, Director of Fixed Income at Richard Bernstein Advisors, to the conversation. Michael, always good to see you. What was your takeaway here, and were you surprised by the market's reaction?
You know, Steve is absolutely right with regards to, everything he said about Chair Powell being happy about the market's reaction today. I mean, listen, this is a Fed that, needed to get more hawkish. So maybe I would push back a little bit on Karen, only from the perspective, Karen, that, I just don't think he did enough to articulate the view that the Fed wants basically a slowdown in the economy and is okay with that. And what Chair Powell has done over the last, several months is basically reiterate this idea of a soft landing, how it's possible, how the unemployment rate doesn't have to go up that much. And I know he's trying to be optimistic, but it's served against the purpose of actually being hawkish, which really the committee is, right? And so I think today's reaction is exactly what it should have been. The 2-10s curve is really, really important. I think that, as that has gotten more inverted, that's going to slow the economy. It's going to continue to slow bank lending. And at the end of the day, that's the goal of the Fed in terms of their hikes. And so I think he's very happy with the market reaction. I think it's exactly what we all should have expected. And I don't think it necessarily stops here either.
So I'm sort of confused about the part where we don't agree, because I sort of agree with everything that you said. But I thought there was someone who questioned him and said, housing slowed and that you want the economy to slow and you want jobs to raise unemployment. And he said, yes, I recognize all of those things will happen. Maybe he should have said it a little more forcefully, but I thought he was admitting we have to do this, that it's collateral damage that for a higher purpose.
Today he did, Karen. There's no doubt about it. I think the last press conference he got a little bit too cute, and probably the last couple times he's spoken, quite frankly. I wrote a piece about this back in, I believe it was February, how his communication strategy at the last FOMC may have been his biggest blunder since basically COVID. I thought even though the committee was very clear that they were going to be higher for longer, he kind of left the door open to really a chance for a soft landing and unemployment not going up that much, and there just not being that much pain. I think, quite frankly, Chair Powell, representing the committee, had, although not declared victory, had started to see signs that maybe all of their policy had started to work. And now he's had to backtrack on that a little bit. And I think that's what today was. And so I think he's finally acknowledging, for the first time in a while, maybe not since the summer, that there's going to be real pain. I think that's exactly what he needs to communicate. Listen, you can't bring down demand and the service side of the economy without bringing up unemployment, right? And there's just no way to do that. It's a fairy tale to think otherwise. And so I think communicating that today was the right thing to do. And, I think there's probably more of that to come over the coming weeks, particularly if we get a strong CPI print, a strong jobs number, or a strong retail print, all of which are going to happen before the next meeting.
Just quickly, Michael, I'm wondering if you think that he is basically saying that a hard landing is possible, an acknowledgement that is, before it was always a soft landing is still possible, but if he said that is a possibility here, that could really get the message across.
Yeah, I think that's exactly right. I think he needs to say that a hard landing is possible and that we won't cut rates until the unemployment rate goes up, 100, 200 basis points. That's going to get the message across once and for all. Maybe he'll say that, in coming meetings. If the market does its work for him, he won't need to. But listen, the loosening of financial conditions this year has really been something. The increase in inflation expectation has been pretty dramatic. And there's an easy way to satisfy what the Fed wants to achieve. And that's to basically say unemployment needs to go up.
Michael, good to see you. Thank you.
Yeah.
Michael Contopoulos, Richard Bernstein Advisors. What do we see today? Banks getting crushed. Yep. We saw real estate getting crushed. All the things that depend on lower rates to work. Or not in a steep inversion.
I don't think banks depend on lower rates to work.
I meant the inversion.
But I know it always seems to trade with that 2-10 spread, even though I don't know that it has that 1-to-1 effect or more than that the market seemed to assign today. That seemed overdone.
Well, look, I mean, it comes down to this. I think in 2018, in my opinion, Jerome Powell in October was on the right course. He said, we're raising rates, autopilot, the whole thing, reducing our balance sheet. And I think then, and I said at the time, they were on the right course of action. And he got browbeat by that administration, and the market went down 19.9%. And my sense is he's not looking to make the same mistake twice, nor is he looking to make the same mistakes that were made in 1972, 73.